Well, hello again. We are going to be finishing our last video on the finance chapter, and today we're going to be talking about consumer credit scenarios. This is where we're working with loans, and this is just going to be a basic introduction to loans. If you take the next course, the MGF 1131, you will get into actually applying more of these formulas into different types of loans. But basically, for any loan, the principal is the amount of money owed at any particular time. Interest is charged on the principal of a loan. And to pay off a loan, you're going to have to gradually pay down that principal. The loan term is the time you have to pay back the loan in full. This is basically our formula for a loan payment using installments loans. Now, this is whether N is the same as we talked about in the last video on compound interest, but N is how many times it's compounded or the number of payment periods per year. So if you're making monthly payments, your N would be 12. If you're making quarterly payments, your N would be 4, and so forth. However, we are not going to be using this formula for this particular section. Instead, for this class, you can use this loan calculator at calculator.net. And what you'll do is you'll just go under Financial Calculators and click on Loan Calculator. And I'm going to go to that website today and show you how to apply that with the next problem. With example 1, this is how we'll just start right here. Suppose that when you graduate from college, you have student loans totaling $30,000 at an APR of 9%, which you are paying off over 10 years with monthly payments. Question A, what are your monthly payments? All right, well, this is where I'm saying, now keep track of this. We're borrowing $30,000, 9% interest, 10 years. So here I'm going to go to the calculator. So I'm going to pull this up. This is calculator.net. This is the first page that you will see. From here, you're going to go under Financial Calculators and click Loan Calculator, because that's what we're looking at today. I'm going to scroll down, and all you're using is just this first box on the left, so upper left-hand corner. Here is where you're going to type in the loan amount. Now, it said it was $30,000, and it's for 10 years. That's already in there. Then we're doing it for 9%. And then here is where it will ask you how often you're making the payments. In this particular example, it said monthly, so I'm going to click monthly. So we're going to pay back every month. Now we can click calculate. And you'll see right up here, here is your payment every month. Here's the results. So you use this calculator, your results are to the right. Your payment will be $380.03. Okay, so now I'm going to go back to our notes and I'll write that here. So we just found out that from using that calculator, our loan payment, and this is great if you want to get a car and just see what kind of payments you might have, but that's our monthly payment. Now, question B says, how many total payments will you make and how much will you pay over the lifetime of the loan? Total payment. So we have $380. That's each payment. You're going to be making these payments every year, every month. That's 12 payments a year. And the loan is for 10 years. Now, this is provided you're not paying anything extra. You're just making your monthly payments, 12 a year for 10 years. Multiply all of that together, and we get $45,603.60. That's how much you're going to be paying in total after borrowing $30,000 up here. Question C, part C. What is the total interest you will pay on the loan? And what percent of your total payments do the interest payments represent over the life of the loan? This really is a two-parter question. So part 1, total interest. Now, how do we find the total interest? Take your total amount that you're paying back. That's what we found in part B, minus the amount you borrowed. You borrowed $30,000. So track those two, and that tells you how much you're actually paying the bank for this loan. That's the interest. That is their profit. You're paying $15,604 in interest. So in other words, you're paying back the $30,000, but then in addition to that, you're paying back over $15,000 for the interest part. Now, I said this was a two-part. This also says, what percent of your total payments do the interest payments represent over the life of the loan? This is going back to the first section that we talked about in our finance chapter, which was on percents and decimals. We want to know the percent of the interest over the total payments. Well, we just found out the interest is $15,604, and the total payments was $45,603. You know what? Let's just round up. Let's just do 604. That way we're not doing the decimal. So let me just erase that. There we go. Let's just round that up. So 45,604, just to estimate. So we're taking what we're paying in interest over the total amount that we paid, and this is going to give us our rate, or the percent. We get 0.34, and if you recall, to put a decimal into percent, we either multiply by 100 or move the decimal 2 places to the right. 34%. What does this mean? Because this is the part where I always say, sometimes we can get a number. We got that. We can do the algebra. But what does this mean? This means that more than, because if you think about 34%, that's more than a third. A third is like 33.33. More than 1/3 of the payments will be interest. That's basically what that means. You're paying your payments, but more than 1/3 of those payments is going to be for the interest. I know, not something we want to think about when we're doing loans. It gets worse when we look at mortgages. We're going to end with just a little bit about credit cards. I'm sure most of you know what the credit card, right? It's a way of borrowing money, but it tends to be very high interest. Here are some pros and cons. Credit cards can be convenient, right? You've got a card, you can quickly make a purchase with it. 2, if you pay the entire balance by the due date each month, you can actually avoid paying interest. Meaning, if you make a credit card payment, but you pay it by the end of the month, you usually will not have interest. Here's a con. If you don't do that, then you will carry over a balance, and interest will add up quickly. So there are pros and cons to a credit card. I don't want to give any advice on that, but just something to think about. It's what we call an open-end installment loan. So let's just do a couple of definitions that you're going to want. With credit cards, there's like an average daily balance. This is how they do that. The average daily balance is the sum of the unpaid balance for each day in the billing period divided by the number of days in the billing period. Going off. So the average daily balance when you're looking at a credit card is basically the sum of the unpaid balance for each day during that billing period, but then divided by the number of days in that billing period. That's what we call the average daily balance. And when you're using a debit card, these are just key things I want to talk about here. The money is actually deducted from your bank account. It's different than a credit card. So it's automatically deducted from your bank account. In other words, oops, not that. Trying to think of two things at the same time. Okay. Credit card, you're making a purchase, but you're borrowing the money. With a debit card, that automatically just takes money out of your bank account. That's the difference there. And to find details on your credit report, when credit accounts were opened, latest balance on each account and payments history can be found. So in other words, I'm going to continue the sentence. To find details on your credit report. And what that means is when credit accounts were open, this is what you'll find on your credit report. The latest balance, the payment history. Okay, this can all be found in a credit report, which we had just mentioned, but I'm going to put this on here again because I'm going to keep going. On a credit report. Hence, credit scores can range from typically 300 to 850, where the higher your score, the better your credit. That's how a credit scoring works. So if you're going to go get a loan, a car loan, student loan, mortgage, what they're going to look at every time is they're going to look at your credit score. And you can get that by looking for your credit report. Just Google annual credit report and you can usually get it once a year. You can check your credit score. But that's just something to think about when we're talking about credit cards and just keeping our scores. You don't want to be over limit or have too high of a limit or balance on your credit cards. That just helps keep your score higher. But if you have too much of a balance, it lowers your credit score. So I hope you enjoyed the section. It was short and sweet. Thank you.